from that, the direction of the break, we see a high velocity move in price action. All right, volatility squeezes can happen either at trend continuation or trend reversal. You just have to pay attention to the break. 3 things to consider when I look at charts. What is the trend doing? Where is the oscillator at? Is there anything important happening with the zero line? That way, I don't have to think about even the name of the security or who that chairman was that pissed me off the other day on news media, right? We can just look at the price action. So let's talk about Tata Motors. Everybody familiar with Tata Motors? I don't own a Tata, but I was here when the Nano was introduced. Before it caught fire and caused all sorts of things. It was revolutionary. India has had so many revolutionary ideas. How could you not be bullish on this country? It is an absolutely incredible place. I mean that dearly. So Tata Motors, right? Massive, year-long consolidation, more than a year, where we were stuck in Nowheresville. Your clients are not getting any reward for holding Tata Motors in their portfolio throughout that whole period. It's going nowhere. But when it breaks out, where does it break out? It breaks out of a squeeze to the upside. Well, look at that. The trend continues, and where to go. So, when I look at a chart on the far right side, where are we at? You guys can shout it out. What's the trend color? Oh, you probably can't even see the chart. I'm so sorry. We'll have to bring magnifying glasses for everybody in the audience next time. The trend is in a strong go condition. We've got blue bars. Where is the oscillator at? It's at +3. So we've got bullish momentum and a bullish trend configuration. Anything happening at the zero line? Well, the oscillator found support at 0 from above. The trend continued higher. We have that continuation icon, green circle. It's the holy grail. Momentum is resurging in the direction of the trend. This is a weekly time frame. It's a bigger picture chart. What if we want to zoom in, right? Let's look at some multiple time frames. Let's get down to the daily chart for Tata Motors. There was the run-up, and we had another consolidation. Isn't it amazing how markets are fractal? Tata's doing the same thing on the daily chart that it did on the weekly, but here we have this breakout. Where's our trend indication at? Strong go, blue bars. Where's our oscillator at? +5. So we're at an overbought level. Anything important happening at the zero line? Nope, our oscillator is overbought and we're on heavy volume. This is a parabolic move in Tata. This was as of the close last week. So that's Friday's bar. How did it do today? Everybody watch Tata Motors today?
Moved up substantially.
Moved up substantially. So I never know what the future holds, but probabilities tell me that when something is in a trend, when the investors have figured out there's something really good happening from a fundamental basis, it tends to continue in that direction. All right, let's zoom in further. For all of you intraday traders, let's look at a 78-minute chart. Divides the day into 5 equal parts. Well, there's Friday at the right side of the chart. Where are we at? Strong blue bars. Strong trend conditions. Where's the oscillator at? +6. What's happening at the zero line? Absolutely nothing. We're remaining overbought. This is that beach ball that won't come back down to earth. It's filled with helium. Good job, Tata Motors. I couldn't tell you exactly why, but there are great investors out there who have probably done all the fundamental work on why Tata Motors is such a strong company. I hire them to do all that fundamental research for me. The market tells me that I want to own Tata. All of that fundamental information is distilled in price, and that's all that I need to know. How about looking at a 39-minute bar? Same kind of thing, right? We're in strong conditions across multiple time frames. You get the picture. Let's look at another one. Infosys. Okay, a little different picture, right? Where's the trend condition? Weak form of a go trend. Aqua bars. Where's my oscillator at? We're testing 0. We're at 0, excuse me. And momentum is retesting the zero line from above on light volume. So it paints a little different picture than what we saw with Tata Motors. More importantly, I can see right away on this chart that we're in a structural downtrend. Lower highs and lower lows. So on this weekly time frame, we are in a trending market. But I know that we're going to have to create some new highs. We're going to have to break out of this downward sloping trend line for me to get particularly interested in Infosys. Now, that downward sloping trend line happens to be acting as support, right? We broke out on that new go trend, and we are immediately coming back to test and see if that will hold. Well, there's really good risk reward we have a clearly defined risk level at which we can trade against with something like Infosys, against either that trend line or the zero line for our momentum oscillator. If that breaks down below zero, I know it's negative. Now let's dive into the daily time frame. Well, what happened on Friday? We actually fell out of the trend model. That last bar is amber. It's time to go fishing on Infosys, meaning from a longer term trend perspective, we don't have enough information to tell us that which direction the trend is heading, but it's clearly fallen out of its go trend. Where's the oscillator at? -1. Ooh, that's bad, right? In a positive trend, if we're in a go trend, we would expect to see positive momentum. Enthusiastic selling in a go trend is not going to persist. If there are enthusiastic sellers of Infosys, that trend will reverse, right? That's a breakdown out of a max squeeze. And what did we say about trading in the direction of the break? Right? Tug of war between buyers and sellers has been won. Who won? The sellers. The sellers of Infosys have won, and now everybody's piling into that side of the trade. Dive into the intraday chart. It's actually already into a no-go framework. We're on purple bars in a strong no-go condition. Momentum is at -3, and we're cooling from that extreme oversold position. So it gives us a little bit of a framework. On Friday, we gapped lower, and we're actually starting to recover already. So depending on your time frame, maybe you're looking to get involved in Infosys. Maybe your longest term chart is the daily view. Maybe you're looking to get back into that longer term trend to the upside on this intraday chart. Everybody with me on the multiple time frame? It's a deeply personal decision about what time frame you want to be trading. But from the multiple time frame perspective, if you're an intraday trader, you have to understand that the very long term, that weekly chart is not looking great. But we're still in conditions on the daily, so maybe you're looking for this spot of capitulation and looking to get back into Infosys. The point is you can have the full technical perspective at your hands, and you just have to follow your rules in order to make those entries. So here we're on weak no-go. If you get to a shorter time frame, 39-minute chart, we're at -1, and we're coming back to test the zero line. All right, last little example, Bank of Baroda. Man, that's a good looking chart. Look at that trend. Weekly time frame showing us multiple years of strength. We're in a weak go trend right now. Oscillator is at 1, and we are approaching the zero line on heavy volume. So we're in that dippable moment, right? We have to decide whether to buy into this. And if we dive into the daily basis, and maybe if you're a longer term investor, you're going to look at these shorter time frames to actually time your trades. So on the daily basis, we're in a weak go trend. Where's the oscillator at? -3. We've actually broken down through the zero line. Negative momentum is not a good sign for a go trend, and we are on heavy volume, falling. 78-minute intraday chart. We've topped out. We're trading lower. You guys get the picture. And we could get even shorter time frame and see that that's a little more recovery, coming back to retest the zero line on this 39-minute chart. That's the example of how we think about the trading rules. Now here's the last section. Everybody still with me? Kaizad, how am I doing on time? 10 more minutes. Yeah, is that okay, Joel? 3 more minutes. All right, give me 3 minutes. So top-down perspective, we want to look across the asset classes first. Right? So I've got a multi-chart layout. I know it's a little hard to see, but U.S. equities, they're in a go trend. It's weak, but it's still in a go trend. How about U.S. Treasuries? Strong no-go conditions. We do not want to be buying government bonds in the U.S. right now. How about oil? We're in a weak go trend, right? Massive rally. It's drifted lower through 2023, and then we had that breakout. Yes, it spilled over, but we're still holding trend. How about Bitcoin? Anybody involved in cryptocurrencies? Maybe, okay. Drifting higher, it's on a weak form go trend. Gold is in go fish territory. It's been a highly volatile trade. And the US dollar, probably the strongest of all in that upward go trend. Now, here's where data visualization really helps us in terms of our portfolio construction. We can take those same 6 charts, the multi-chart layout, and just look at a heat map. So forget the price action for a second. If you're running a model, and you have your rules, you can identify those trends. You don't even need to look at the price action if you're just thinking about understanding the environment that we're trading in. So from the macro view, those same 6 charts across the asset classes look like this. What's the one that we want to stay out of? Bonds. I was born, I top-ticked the, the fixed income market. It's been a downtrend for 42 years as of yesterday. But we broke out on a quarterly basis in 2021. And so it's a new regime, it's a new environment. And bonds do not provide the safe haven that they used to in terms of diversification. All right, let's make this specific to the India context. Same thing, what's the absolute trend? Top panel, I'm looking at Nifty. We're in strong go conditions. This is a daily basis. Second, Bank Nifty. We tried, came back to a no-go trend on an absolute term. How about Nifty Junior, right? The next 50 after the first Nifty 50. Back into a strong go trend. How about mid-cap? My goodness, I hope you all just bought as much mid-cap as you possibly could. This trend, and the chart looks amazing. I've never seen anything climb so steadily. So mid-cap names in the Nifty Index, looking really good. Uninterrupted go trends. How about the BSE Sensex, industrial average, 30 stocks? A little weaker, right? So that gives us a lay of the land. What indices do we want to hold longer term? How do we want to trade them? Well, it's great to look at things on an absolute basis, but what if we looked at them on a relative strength basis? If we're a portfolio manager and we're doing asset allocation, from a style standpoint, we might want to own growth equities, or we might want to own value shares. So we could pull up 2 charts and just eyeball them and see which one's better than the other. My eyeballs don't really tell me that there's much of a difference through the pandemic, right? They were both rising, they crashed in 2020, and they both rose out of the pandemic. There's some differentiation, some divergence here on the right side, but what we use is relative strength to tell us what is happening in that comparison. So if we divide growth by value, we get that relative strength line in the bottom. Now, what about the trend of that relative strength line? Well, it tells us that growth began outperforming value ahead of the collapse. So the market knew about the stay-at-home trade long before we had even coined the term. The market knew that growth shares, the information technology, consumer discretionary, communication stocks in the US, those were already outperforming value shares, right? The market knew industries were going to be shut down. And then we saw this period where rates took off and you had a strong underperformance of growth over value. So we want to own value in those times, right? Right? The tech sector rolled over. We saw banks, energy, financials all coming into leadership. So now we can look at those trends in the same kind of framework. GoNoGo chart. This is growth to value on a weekly time frame. And this is the start of that new trend in growth equities, outperforming value. Now that's pretty constructive to me. That tells me people aren't buying the most defensive sectors of the market. Investors prefer growth equities to the value counterparts. Looking at that on a daily basis, you get the picture in multiple time frames. Technology versus utilities. Do people want to buy a utilities company? It's like the least sexy thing you can talk about at a cocktail party. It's talking about the utilities company that you own and the little dividend it paid you. People want to talk about the big story, the tech firm that's going to change the world, right? The geo-revolution. That's what's happening right now. Investors own the technology, not the utilities. They're willing to take more risk. That's what this chart tells me. Markets are risk on. Despite what we're hearing on the news, markets are risk on from this chart, okay? Let's make it specific to everybody in this room. Do you want to own the Nifty or do you want to own gold? Well, let's look at the chart. We wanted to own gold all through this pandemic period, right? Gold is outperforming the Nifty throughout this big drawdown. So on a relative strength basis, Nifty began to outperform gold here at the end of 2020. October, we actually confirmed the new trend, and man, did it take off. Had periods of underperformance against gold. Where are we at right now? And that was a heavy day on Friday from a relative strength basis. Gold spiked higher, but we're still in trend. And so holding equities over gold is going to give better outperformance to your portfolio. That's how we think about portfolio construction. Let's take it a step further. What if we look at each sector of against the Nifty 200 benchmark? And I'm just picking the Nifty 200 as a diversified basket of securities. But we can look at the individual sectors and how they're performing relative to the Nifty. So let's go from top to bottom. We've got public sector banks outperforming the Nifty. Private sector banks outperforming the Nifty. How about general financial services? It's like the glide path of a brick off the roof, right? We don't want to own those. How about fast-moving consumer goods? Haven't wanted to own them. There's a little spark of life as of last week. Healthcare, underperforming. Pharma, underperforming. What's that? IT just rolled over. Media, kind of trying to hold on, seems a little undecided. How about metals? It's a no-go. Weak form, but no-go against the benchmark. How about oil and gas? No-go. How about consumer durables? Yeah, we just went to neutral. It's been a good trend. How about the auto sector? Everybody own some autos? It's a strong relative outperformance of the Nifty 200. And how about real estate? My goodness, I wish I owned some Delhi properties. Real estate is through the roof. So that gives us a little heat map from a relative perspective about where we might want to do some asset allocation. But as brokers, what this is going to tell you for your customers is where they're going to find good idea generation. Right? We want to put probabilities on our side. So fishing where all of the fish are is pretty helpful to us. Right? We want to be looking for long opportunities in those sectors that are outperforming the index. We want to look for short opportunities in those that are underperforming the index. This is what I do for US investors every single week. We look at the sectors relative to the S&P 500. That chart just showed that technology was outperforming. Then we take it a step further. We get within the sector and we're looking at the industry groups. So within information technology, what's been outperforming? Two areas. This was semiconductors in the top level, and this was a renewable resources, so renewable energy, but in the technology sector, so the software and the firms that are supporting the green energy movement. I didn't even know that was an industry group in the infotech sector. So then we get to individual names, and we can see that semiconductors like NVIDIA had a great run. I don't need to belabor the point. We go through our three methods. How about within the renewable energies? Here's a name, First Solar. That's in the tech sector, but it's in the industry subgroup on renewable energies that's outperforming the sector, that's outperforming the benchmark index. So now we're putting all the probabilities on our side, right? But even at the industry group level, there's still diversification. Here's another name from the same renewable energy index, Plug Power. A little different looking chart from First Solar, right? So our job in the brokerage industry, right, we can look at these tools, we can look at, yes, equities are in a go. Now let's get under the hood and look at the sector groups relative to the index, find those areas of leadership. Then we can get within the sectors that are leading, we can find the industry groups that are leading those sectors. And then we can get to the individual names and do our work as traders and manage the trade around what's looking right on the chart. So if Plug Power is in this ultra top echelon of outperforming industry groups, and it looks like this, it seems like that's a great short trade, right? There's something clearly wrong with this company if they can't find some outperformance when they're associated with such a great group of companies. You all have been absolutely fantastic hosts, and I hope that when you are next in New York, I can show you any of the same hospitality that you have shown me. I really appreciate your time and attention, and I'm happy to answer a couple of questions, although I know I just went like 10 times longer than I was supposed to, but I wanted to get through that whole thing. So, any questions that I can answer for the group? Yes, sir.
So, there are a couple of questions.
Sure.
First question is when you talk about moving averages. I think with your experience, what kind of a moving averages or moving average crossovers are better? And you have to take it simple or you have to take exponential. So that is my first question. Second, when you talk about RSI, what kind of a time frame you are looking at in RSI? It is considered to be one of the internal strength index.
Yep.
Which, according to your experience, how much time frame we should consider for that?
Okay, so great questions. With each of the indicators that we ran through tonight, you can change the parameters. So 14-period RSI is sort of the standard, and that's what's going to come in all of the charting packages that you might use. I've tested and looked around, is it better to have a slightly faster moving RSI? And here's my conclusion. In back tests, it doesn't change anything. And if you want a faster moving chart, then change the time frame of the chart that you're looking at. So if you are intraday and you're looking at hourly bars, but you wanted a faster exit, I would start looking at a 15-minute bar as a second time frame. Instead of changing the RSI parameters, I would change and look at multiple time frame charts. The second question you asked was about moving averages. And I went down this rabbit hole very early on. I was like, oh my gosh, what a simple, elegant, and perfect concept. If one moving average is good, then multiple moving averages are even better. And what about 10 moving averages on the chart? And I can see all of the crosses, and I can really gauge what's happening. Here's the problem. The more lines that we add to the chart, the more confusion we're giving ourselves when it comes time to make the trade decision. So the most commonly used 50 period and 200 period moving average. So if you're looking at a daily chart, that's 50 days and 200 days. You can look at a 200-month moving average if you're looking at a monthly chart, and it's going to give you the same information. A 50 period moving above a 200 period, that's inherently bullish. The difficulty is that's what everybody's looking at, right? You need something more than just a moving average strategy. And when you backtest it, what's amazing about a very simple moving average crossover strategy is that it works. It still works. People have known about moving averages for a very long time. But you're very late to enter and very late to get out. And that's typically what people struggle with in terms of trend following. Trend following loves all the garbage at the top of a bull market, right? Trend following is long meme stocks when they're peaking. It's long SPACs, it's long cryptocurrencies right before they collapse. So from a moving average perspective, I would just say the most important thing to use with your moving averages is a stop loss. Any other questions? Yes, sir.
Yes, sir. My question is regarding CMT.
Yeah.
So in CMT, I checked a decade back, you have Elliott waves in your curriculum.
Mm-hmm.
So I was like, the only reason that I never went for CMT because Elliott wave was there.
Mm-hmm.
Now my question is, can we combine Elliott wave with palmistry or astrology or even crystal ball gazing? Because I read it at that, and why not CMT is considering that? I mean, I don't want to be too harsh, but I consider something to be, irrelevant to technical analysis, and I feel that you can consider taking it out of the curriculum because that was the only reason that I never went for CMT. Otherwise, I would have got CMT decade back.
Sure.
I wanted your comments on that one.
So, quick show of hands.
Thank you.
How many people use Elliott wave counts in their charting? Got a hand in the back. One here. Okay. In the currency markets, people use Elliott wave charting everywhere. Now, here's what I will say from my personal opinion, and then I'll answer the question about the CMT program. For me, the things that work require them to be very mechanical. Maybe I wear my heart on my shirt sleeve. I get very emotional, particularly when it comes to money, right? So if there's any interpretation or subjectivity involved, and that's just me, I can't quite handle it. I can't stay disciplined if it requires my interpretation at that level. So that's my personal view on Elliott wave. Now, what was crazy helpful to me when I went through the CMT program was that technical analysis is picked up often on the trading floor. People are learning technical analysis through osmosis. They hang around a bunch of traders and they just learn technical analysis. Well, when you go through the CMT program, it's a structured approach to understanding this whole cornucopia of tools. And that includes understanding some of our historical roots. Everybody know where candlesticks came from? Monohisahoma, 250 years ago, in the rice pits of Osaka, Japan. He's understanding that there's behavior in these trading pits. And if he could chart the price action, he'd get an understanding of what that behavior was and be able to use it to his advantage. R.N. Elliott, with no computers available, this is the 1920s, began to understand some of that wave concept that Charles Dow first articulated, and he thought about how fractal markets are, and that you could do a wave count and see fractal moves within those waves. It's a brilliant concept, and it actually really helped me to think about keeping an open mind. So if I look at a chart and there's a wave count, you can use it to your advantage to keep an open mind to what scenario might play out. Meaning, I don't know what's going to happen tomorrow. But if things were to totally collapse and we're in all-out open World War III tomorrow, what kind of projections should I have on my charts? How far down could we fall? Are we back to the 666 level on the S&P 500? Based on some wave counts, yeah. So, as an investor, you have to have very strong beliefs, very loosely held. Meaning you have to be open to a trade working or not working in your favor. Any other questions? Yes, sir. We'll have to take the questions later. Find me on LinkedIn, shoot me a DM on Twitter, email me, come to the CMT Association meetings, ask me questions about the program. I don't have all the answers to the exam, but I look forward to meeting all of you at some future date. Thank you so much.
Wonderful presentation.
Yeah. Otherwise, you're going to have to talk to my wife tonight.
Yeah. So we are running behind the schedule. Before I proceed further, and I would like to acknowledge the presence of Mr. Priyank Khandelwal from RBK Broking, Janam Parikh from Janam Share Surat, Mr. Nitin Shahi from Findoc Ludhiana, Mr. Iqbal Singh from Chandigarh, Mr. Divyesh Shah from Varanasi, and Mr. Jitendra Keshwani from Agra. So I am very thankful to all of them for traveling distances to attend this program. And our program is graced by the presence of another distinguished speaker who is an authority in the field of technical analysis, Mr. Joel Pannikot. Mr. Joel Pannikot has spent over 20 years across various sectors of the education technology industry, including commercial education, corporate training, and continuing professional education. Currently, he is the APAC head of the CMT Association and founder of Peak U. His work uncovers learning synergies between the industry, academy, and the non-profit sector. Prior to these roles, Joel was the CEO of Zaya Learning Labs, an education technology social enterprise that sought affordable access of digital learning. Now I would request Joel to kindly come on the dais and share his presentation.
As you can see, if you look from a reasonable distance, there is literally no difference between Tyler Wood and me. Or if you know us very closely, you probably can't tell the difference between us. But it's been a pleasure for me. I think in terms of public speaking goals, this person is career goals for anyone in the world of public speaking. So, and I never get bored of his presentation, so it's super, super encouraging. As for being here with ANMI today, Vijayji, thank you so much for having here. Hemanji, your efforts have been fabulous in just making this evening happen. So thank you all for being here. And just it's humbling to think that so many of you have traveled from so many different parts of, not just North India, Jainam, but from all the way to Surat as well. It's very impressive. And the fact that there is this love for knowledge is also so fascinating. Now, in terms of logistics, officially the session was supposed to end at 7:30. So I have 3 minutes. No, but we did start a little late as well, so that's all good. But this deck that I have used the same deck to do a 1.5 day long session, a 3 hour long session, and today let's try and see what we can do with a 3 minute session. But it's a pleasure, it's a lot of fun for me to kind of explore these opportunities. But I also want to take a moment, and for Kaizad and me in particular, our relationship with ANMI goes back to our time at Bloomberg. So both of us have worked at Bloomberg for 7 years, overlapping for about 4 or 5 years. And we've had this fabulous relationship of managing Bloomberg's relationships with the broking community. And working with ANMI has always been a tremendous pleasure for us. So for me to come here in my CMT avatar and talk to the same group, thank you so much for having me. Why I like this picture is because this year CMT Association completed 50 years of service to the financial services industry. And this picture was when the New York Stock Exchange invited us to ring their closing bell. You can see Tyler at the bottom left corner of this chart. But this was their way of acknowledging our contributions to the industry for this long. But, and also, yeah, we talk about behavioral psychology in a bit, but let me just give you a very super fast reminder for the, most of you know what the CMT Association is, but this is kind of my 5-part definition. The Global Credentialing Authority committed to advancing the discipline of technical analysis across the financial services industry. What does that mean? Global, because we have members representing 137 countries around the world. Credential, because the Chartered Market Technician credential is far and away the most respected designation in the world of technical analysis. Very importantly, because the curriculum also updates consistently. So, to your question, the portfolio of content within the curriculum as well has been rebalanced since 2017. Elliott wave theory was moved out from level 3, where level 3 has now begun to focus on systematic trading and has been brought to level 1 as an introductory note for anyone who wants to get into and find out more, like Tyler said, about the optimization of Fibonacci retracements, which is at its heart what R. N. Elliott initially discovered. So there is a lot of work that goes on in building a curriculum that is robust. Every 5 years, there is a 3,000-person survey done just to make sure we know what is the cutting edge of the industry. Today, the cutting edge is systematic investment analysis, quantitative trading, algorithmic trading, and that requires much lesser subjectivity, much more mechanical system-based thinking. So what we are doing is understanding what the market is doing and making sure that we are serving that knowledge at the highest level possible, credentialing for that, right? So that's just a quick, just to, if it's any consolation, we welcome you to the community even now. But why we do and why CMT Association exists is probably even more important. Because as an advocacy body, we work with regulators and exchanges, we work with employers, academic institutions and the media, because here's the challenge. The barrier to entry to calling yourself a technical analyst is very, very low. Let me put it this way. Any fool who can see your head and shoulders can turn up on CNBC, offer nonsense investment advice, and then people like my father listen to that advice and invest their retirement capital. As investment managers and the broking community, that we need to understand is a real fiduciary risk. That is why we are asking not just professional investment managers and their money, but people like my father, whose entire life's capital is based on trust with his broker. So my ideal life goal with the CMT Association is, if tomorrow when someone comes to my father with investment advice, and my father turns around and asks, are you a CMT? I think my job will be done. But that is why it is important for us as a community, as an industry, and even in dialogue with regulators, for us to talk about why the discipline of technical analysis is important. It is important to make returns, yes, but far, far more important, it is critical to protect our end, let's say our end stakeholders, the people who trust us with their capital from market risk. So that is what I feel our mission is as professionals in the industry. So that is why we exist. And that is why we try to define technical analysis the right way as well. So talking about this, we were just talking outside about Professor Ashwath Damodaran, who helped inspire this graphic about how technical analysis helps to navigate the gap between intrinsic value, what we call fundamental analysis, and market price. Because if intrinsic value was always equal to market price, the markets would be efficient, theoretically. And efficient market is a hypothesis, which has been disproved several times. But that's a different conversation, we'll get to that. So what we try to talk about is the importance of the angle of behavioral psychology. Why the market is the sum total of the expression of the behaviors of human beings trading it. With information asymmetry, with emotional asymmetry as well. Not everyone feels the same. And the other, the pyramid there I like very much, because in today's age of quantitative finance and algorithmic trading, हर किसी को algo trader बनना है. And everybody thinks, मैंने Python सीख लिया तो I become an algo trader. Then we try to remind them that you can learn all the coding languages you want, but what do you use those coding languages on? So you need to understand data. And you can gather all the data you want. I mean, I made a lot of money for Bloomberg by selling terminals at $2,500 a month. But if you do not know what principles to apply to that data, what are you going to do? And with every generation, the coding language changes. But the principles, the first principles remain the same. So we try to bring attention to that as much as we can. And that is our role across the financial services industry. In fact, I use this chart with students to remind them that technical analysis is not limited just to us as in the broking community or even to just the investment managers we serve. But it is literally spread. In fact, this outer ring here, there is a CMT working in every single subsector and sub-industry of the financial services industry. And in fact, now we are trying to work with NISM, who's part of our academic partner program, to create courses for SEBI officers on understanding technical analysis to do their job as regulators. Market surveillance, investigations. There is so much more that we can do. So that is where CMT Association's role is in the space. And I wanted to bring this up because now that CMT Association has turned 50 years old, we are looking at our mission starting off as a US-centric organization, where people found out post-2005 about CMT because FINRA recognized, SEC recognized the CMT and CFA qualifications. If you had cleared level 2, you were eligible for Hamare Series 15 jaisa, unka Series 86 exam. You were eligible for that. And from that time, while the brand of the CMT Association got exported, the culture of the CMT Association is what we are bringing to the world now. I'm very lucky because I got to be the first employee of CMT Association outside New York in 2018. So this is my 5th year. In my 5th year at CMT, in the 50th year of CMT Association, it's an opportunity for us to take it to the next level. So that's really just a quick background of where we are. Coming to my session today, I have -4 minutes. But what I'll do is I've taken the liberty even before getting here of sharing my slide deck with Hemantji, and I would love for him to share it with all of you. A lot of the slide deck, fortunately, is just book recommendations. Because honestly, like Tyler said, we have nothing original to say. Everything that we have to say has been said by legends in the past. And especially in the world of behavioral psychology, you were so kind to gift us the Bhagavad Gita. I think the beginnings happen with Karmandivadikaraste Mafaleshwaraj. To understand process and to focus on karma and not to worry about the results if your process makes sense. And even if you are able to just figure that out, and unfortunately again going after Tyler makes my life easy because he said all the major things that I had to say, so I just have to quickly run through my slides. And one of the things he mentioned was having a rule-based system so that you can step away from the emotional turmoil. And when he asked how many of you had emotional turmoil, okay, I'll come to this here. Almost all of you raised their hands in the middle of a trade. We'll come to that in a second. Another person I was deeply inspired by was, so this picture was from this July. How many of you recognize more than one person in this picture? I'll make it more specific. Who's the old guy? The old guy here is the legendary investor Jim Rogers. Famous not only for building a massive portfolio based on very thoughtful fundamental analysis, but also for traveling around the world on a motorcycle and then in a car. We asked him which country you've not been to, he said Chad. Just the one country. But what I found beautiful about our conversation with Jim Rogers was, he said something very interesting. We went to him asking, so we were doing a roadshow across Asia and planning to find out what makes different traders different. He said, forget about differences. Focus on what makes them the same. Because no matter where in the world you go, if you go to a mother's home, the first thing she'll do is comb her child's hair before bringing the child in front of you. When you trade in the markets, no matter where you are, no matter how experienced you are, you always will feel fear and you always will feel greed. So those common emotions that kind of sit at the heart of who we are as human beings is really at the heart of this. So a lot of this work derives from this original book called Thinking Fast and Slow. So there are all these books are available in the slide deck, and what I've done is taken the lessons from each book, and I've taken a lot of the very powerful presentations made in CMT Association's global events and put them together in the text. So when Hemantji shares those with you, please take your time. What I've also done for the lazy among us is taken the one-line point and said, this is the one big takeaway from this book. And so that's what this slide does, for instance. Talks about loss aversion. Talks about why we are more afraid to take a loss than we are greedy for a gain. And that ties back to what Tyler said about if there are 4 possible outcomes, big losses, big gains, small losses, small gains. Why is it that most of us get stuck in the big losses? And why does that happen to us? So where is the problem? Now, once again, just quick show of hands. Has any of these things ever happened to you? Late entry timing, late exit timing, excessive adding, excessive removing, holding winners too long. For me, all of these have happened. And this has happened, I mean, I had the good fortune of starting to trade in 2004. I used to trade bond futures, money market futures in very nice, beautiful range bound markets. The Fed was doing this very consistent quarterly rate hikes, and I thought this is how the world operates. Then the subprime crisis happened. I learned very important life lessons. I like to joke even today that during my years as a full-time trader, I learned a lot about the markets, but I learned far more about myself. पता चला कहाँ फटती है first of all, and कैसे फटती है. And that I think was a very important journey that sits at the heart of India. Now I've run a lot quicker through this than I had anticipated, but why does this happen? Why do trading mistakes happen is something to think about. Quick question, and if you have seen this is a very popular WhatsApp one. Which is a darker square, A or B? A is darker? Anyone voting for B is darker? Or are they the same color? They're actually objectively the same color. But because of the context, what surrounds it, our brain tries to recognize a pattern. And pattern recognition is an evolutionary reaction. You can actually, this is Edward Adelson illusion, you can actually check the colors from each of the things. And what it tries to demonstrate is that the brain tries to fit one piece of information with the information surrounding it. We are always looking for patterns, which is why we are seeing faces and animals in the sky and clouds, which is why people try to predict the future from tea leaves. And that's not technical analysis. Right? But that's the point. We look for patterns and we seek narrative all the time. And because we seek narrative, we are constantly struggling. Right? This is another one. Can you see what's wrong with this text? The first and last words of each successive line repeat. But as you read it, the brain does not even look for that, unless you know this from the past. Again, because our brain is an optimization engine, it tries to do things as quickly as possible. This story, have you heard of this story? This got very popular on WhatsApp and Facebook. This was this amazing narrative that became popular that this baby, this mother impala is sacrificing herself to the cheetahs so that she can watch her babies run away into the distance. And hashtag mothers love, बहुत popular हो गया. Till the point, and then someone said that the photographer who shot this got depressed and committed suicide. Then the photographer had to go on Facebook and say, "नहीं ऐसा कुछ हुआ नहीं है." And in fact, this is the opposite. It is actually a mother cheetah teaching her babies to hunt. But because we as human beings love a story so much, we latch on to the first story we find, and the more emotional the story, the more we latch on. आजकल के influencer दुनिया में, I don't want to say what the value of stories is. I mean, the SEBI chairperson is coming out against influencers. That is a very important part of why we as a community have to be far more careful. But we are programmed for this. We are programmed to look for narratives and stories. This research was very interesting because this was research done in the Israeli judicial system about parole hearings. You know, whether a person's jail sentence should be extended or cut. And what they found is judges, bakaida qualified, very serious, very well-educated people. When they come to sit to evaluate these hearings in the morning, they're in a good mood. From morning to lunchtime, their mood gets worse and the number of positive results they give drops. They have lunch, they come back, suddenly their mood gets better and their positive results go up again, and it goes down till afternoon, evening chai. And then it goes up again and it crashes to zero in the night. This is among the best of us theoretically, people who are put in positions to judge other people. And if those people can fall prey to what we call cognitive biases, won't we all? And so that is kind of the lesson to take away. We think that our decisions, these are a hairstyle, like I'm just running through it so you have context to it. We think we make decisions based on observations, we see stuff, we analyze it, we apply our theory of what should happen with this information, and we take action. That is what we think we do. In fact, there is a layer of filter between this information and action, which is what we call our cognitive biases. It is how we are programmed as human beings to look for patterns, to look for stories. And these tendencies cause us to make very basic decisions that do not only rely on facts. which rely on our hopes as well. How many times has it happened that we bought a stock and then we held on to it because पहले तो मेरा दिल कहता ऊपर जाएगा. It does not go your way for a long time. Then it goes from desire to wish to hope to desperation. Then you put in the bottle drawer and say, "नहीं ये मेरा education." Okay. I mean, I know a lot of people who are still holding on to Yes Bank. We'll get into that's a different story. But why does it work? This happens because we've evolved to do this. And tragically, our cell phones and the world, the social media world that we're living in, is using the same impulses that were evolved to protect ourselves from tigers 20,000 years ago. In ways that is, so I mean, imagine this, the risk of hearing a loud sound and the emotion that it resulted initially happened because there's a tiger somewhere and you have to run for your life. And that same emotional reaction happens to us every time our cell phone rings. It's the same evolutionary reaction, and it happens not once in a month, but once every minute. And we are not prepared. As human beings, we have not evolved to deal with this. But the brain can be rewired, which is the primary insight knowledge. Like I said, if we had more time, we could have done a lot more. But the idea is that this cognitive bias is a learning process in our brain. Our brain learns to make shortcuts so that it makes our life easier. Do you remember in the morning deciding to get up and brush your teeth? I don't think so. But you did brush your teeth, and it happens automatically every day. That tendency of your brain to create shortcuts to save energy is often what leads us into problems as well. And that is really where performance changes, investment management performance. So, a lot of research has been done with professional fund managers about the gap between what their returns could have been and what their returns actually were. And that too compounds over time. So that's again where we need to explore as investment managers, what are we up to. Broadly speaking, 3 pillars that we think we should focus on, right? Again, I'm running past this, but the technical pillar is something that we focus on a lot, learning more about valuation models. I'll also say learning technical analysis comes into that. The performance pillar, which is how do we trade on a day-to-day basis. We have a lot of ideas on what to do with that as well. But the self pillar, who am I as a person? When do I panic? Why do I panic? Why do I hold on to some trades? Why do I get out too early from others? The self, the I, that is something that we do not think about as often as we'd like. So while ideally we should have a mix of all 3, in fact, this is how we operate. We spend far too much time gaining knowledge and far too little time exploring self. Which is also why some of the greatest traders and investors you know are all very zen people. Because first and foremost, they've come to understand themselves. They've come to understand that there is a time to go long, a time to go short, and most importantly, what is their time to go fish, right? That focus on self is incredibly important. Coming back to those 8 trading mistakes that we talked about, each of those are built off of a real cognitive bias. So, like I said, in सब पे notes हैं slide deck में, please देख लीजिएगा. But each of these, there is a real measured, experimentally as measured and verified tendency in our brain. The anchoring effect. Why is 99.95 rupees so much lesser than 100? Right? These are the kind of tendencies that marketers also use, because these are all tendencies of our brain to attach value and to make decisions in a shortcut kind of way. So understanding and recognizing that is, I think, the most important part of exploring behavioral psychology. Maybe another time we can dive deeper into this. This table, incidentally, was created by Essential Analytics, which is run by Claire Flynn-Levy. It was presented at our Asia Pacific Summit 2020. And Claire talked about, so the result of this study comes from analyzing 67 career fund managers and their performance over 14 years. So it is not just random people, it is serious money managers, and we are all victim to this. Because we worry about, अगर ये नहीं किया तो मेरे stakeholders क्या हैं? You think you enter a position simply because you don't want to regret it in the future. You hold on to a position because you think अब ये मेरा है, इसीलिए it should go up, right? And the importance of mitigating bias in the movement. Her entire business, Essential Analytics, is built on how to eliminate biases. What can we do about this? Act. Awareness, commitment, transformation. And there are a whole series of steps that can specifically be taken, but I'll jump there. The key is, first and foremost, I think awareness. Even if we get that right, a lot of these problems get solved. And that space I talked about, the space between our thinking and our modeling and the actual decision. Being able to pause in that moment and ask yourself, even if you do only that much, ask yourself, is there a bias I might be falling prey to? Utna bhi agar aapne kar liya, you will automatically start interrupting what they call the neural pathways, which go from impulse to action with all these shortcuts. So the brain can, it's scientifically proven that the brain can be rewired, but uske liye consciousness must be, just being aware. Once you are aware, to commit yourself to a transformation and to then take those steps is where this entire game lies, right? And that's what Tyler was talking about in his presentation as well. They say practice makes perfect, but I love this Marg quote. Practice makes habit. Perfect practice makes perfect. So understanding what that perfect practice is becomes incredibly important. So these are the three broad recommendations for what you can do. Setting active reminders or nudges, Claire Flynn-Levy calls this. Ideally, if you are a solo trader, having a partner whom you can bounce ideas off, have conversations with, talking about your decision process and having your partner remind you that this is a mistake you are likely to make. Because when we are in the middle of an emotion, that might not happen. We might not remember to take these thoughtful decisions. Having a partner, very valuable. There is a huge market for trading coaching services. There is a huge demand for it. There aren't as many coaches, and not all coaches are equally reliable. But having a coach, a person who is experienced, give you feedback is incredibly valuable. Habits and systems. A trade journal, I think, for me was the single best thing. Because my trade journal used to also be my personal diary of emotions. I should not just write what my entry was, what my exit was, and why I chose both of them. I used to also write how I felt during the trade. How I felt before entering the trade is always very smart and very thoughtful. How I feel during the trade, as the trade is going on. Do I stick to my rules? Do I stick to my system? This becomes incredibly important. So journaling might be the single most important activity that you do, just from a self-discovery perspective. Again, exploring your emotions, super good. And Tyler, I think, gave a fabulous presentation on a system. Understanding that can take us very far. The mere measurement effect, this one I really love. It is like if you want to lose weight, the first step to do is buy a scale. Sometimes just by virtue of standing on the scale regularly, you remember that you have to take steps. Just tracking what you feel comes back to awareness. Just tracking how you are feeling at any point. And this is not just for trading, this is honestly for life. But doing that consistently has such huge dividends, I can't tell you. In fact, my first startup after my time as a trader was a company focusing on how to help traders fight the same behavioral biases. And you can see amazing changes in people. Again, jab fursat hogi agli baar we'll do another longer session on this. But there's so much to talk about. Books. Now I'll run through a whole series of books that I strongly recommend for all of you. This is one of my favorite. This graph is one of my favorite. Because this also talks about the importance of sticking with a journey. अक्सर क्या होता है कि the moment, in fact, have you noticed the people who talk the loudest often are those who know the least. Because it is a fact that the moment you learn a little, you ascribe too much importance to that. And what this graph talks about? Your confidence versus your competence. Competence increases through consistent learning and effort. Confidence seems to have a very different relationship. When you know little, you think you know a lot, you think you are much better than you are, you start offering your opinions all the time, everywhere. So please, social media, zara sabhaliye. Right? But the key is, see, because initially your confidence goes to the sky, but as your knowledge continues to increase, and inevitably it increases because you are around, you are learning, you are paying attention, most people see a dramatic crash in their confidence as their competence grows. Most people give up in this valley of despair. Yeah.